The purpose of this video is to provide you with a basic background on business combinations. Before proceeding with business combinations, consider the following example of an asset acquisition. P Limited wishes to acquire an asset, for example, for 3,000 Rand. In so doing, it employs its cash. Consequently, the statement of financial position will reflect zero remaining cash, as this has now been transferred into additional vehicles. An entity may, however, wish to find an alternative method of obtaining control of the vehicle. This may perhaps be due to legal restraints in the country or red tape, etc., that the entity wishes to avoid in transferring the ownership of the vehicle. In our example, we have identified S Limited as the current owner of the vehicle. As you will see, the vehicle is valued at 3,000 in both instances. P Limited may therefore acquire the shares in S Limited. In so doing, it would obtain control of the vehicle of S Limited. Again, employing its cash of 3,000 Rand, P Limited now acquires the share capital of S Limited. Consequently, P Limited will now have an investment in shares, reducing its cash balance. In obtaining control of S Limited through the acquisition of shares, IFRS now recognizes the two companies as a business combination, as S is controlled by P Limited. And the first step of doing a business combination is to now combine the accounting records. The resultant accounting records now reflect the investment, the vehicles, and the equity of the parent and subsidiary. What is of concern at this point is that there has now effectively become an investment, being the shares P purchased in S, as well as those shares in a single set of accounting records. To explain this further, perhaps we need to consider the consolidation journals. To visually represent what we have just stated in P Limited obtaining control of S Limited, consider the following graphic. P Limited purchased the shares of S Limited, obtaining control of the net assets of S Limited. Through P having control of S, the outside shareholders of P effectively now have control through P Limited of P and S Limited. Faithfully representing this in substance would imply that this is one entity for which we need to report. A consolidated set of financial reports therefore needs to be prepared. As was shown a moment ago, P Limited holds an investment in shares issued by S Limited, effectively meaning that there is an investment in the entity for which we are reporting its own shares. Obviously, this is not an adequate state of affairs. To solve this problem, a consolidation journal entry is required. This consolidation journal eliminates the equity purchased in S against the investment in those shares in P's accounting records. The consolidation journal entry is now posted against the combined totals of the accounting records of P and S Limited. This now results in a consolidated statement of financial position. It is now very interesting to compare the statement of financial position, where the asset was purchased directly, with the consolidated statement of financial position, where the asset was purchased indirectly through acquiring control of S Limited through the acquisition of S Limited shares. At this point, it is worth mentioning, for simplicity's sake, that our example only included share capital. It is, however, possible that S Limited, and highly likely that S Limited, will have other equity items. This, however, does not change the substance of the explanation. It will, however, mean that your at-acquisition journal entry for consolidation purposes will result in elimination against several equity items, which would, in our instance, total 3,000. P Limited can obtain control of the vehicle of S Limited by owning less than 100% of the share equity. For example, for our illustration purposes, let's assume that P Limited acquires only 80% of the share equity or net assets of S Limited. Considering the conceptual framework's definition for assets, control is vital, not ownership. Through having control of the vehicle in this instance, P Limited is able to determine the use and employment of that vehicle. You will not, for example, have 20% of the vehicle driving in one direction and 80% in the other. There will be 100% control despite only being 80% ownership. The consolidation procedure then proceeds as previously stated. In obtaining control of S Limited through the acquisition of the shares, a business combination in terms of IFRS again arises. The first process in this business combination, or to account therefore, is to combine the accounting records of P and S Limited. This would result in the investment in the shares by P being reflected, and would also include the share capital of P and S. Again, there is the dilemma of having a share investment within one reporting entity for accounting purposes. To solve this dilemma, a consolidation journal is again processed. This will eliminate the investment against the associated shares that are represented by that investment. There will, however, now be a remaining balance. As the shares and net equity was 3,000 Rand and only 2,400 has been eliminated, there is an amount of 600 Rand remaining. This represents the non-controlling interest. A further consolidation journal is now required, which moves the 600 Rand out of share capital down to a new line item which we refer to as non-controlling interests.